Hello everyone, Chris Martenson of Peak Prosperity here, and I'm very excited to bring you today's offering for insiders. You're getting this because you're a subscriber to Peak Prosperity and an insider to our knowledge and everything we can offer back there. So today is just an absolutely gorgeous day here in Western Massachusetts. I'm going to show you a number of things in this upcoming presentation. First, we're going to go through the economic data such as it stands right now, and as well as the Federal Reserve's responses, really as a means for setting the stage for answering this question. Is it time for you to take this all seriously and get yourself resilient and prepared? And the answer is yes. And I want to help ground you in some of that data. I know many of you are already well past that and don't need any additional grounding. You're already fully active and doing what you're doing in the world. But I think it always helps to have a regrounding and a reframing of where we actually are. So I want to show you that because these are unprecedented times. This is extraordinary what we're seeing in this data right now. And then secondarily, I'm going to show you what Evie and I have been up to here in our homestead, show you some of the progress we've made in just 3 months. It's fun to add it up for me because I've been working so hard at everything here across the street with the project we have going on there with making all the videos and, of course, attending to everything at Peak Prosperity. It's been one of the busier seasons of my life. So without any further ado, let's get started on that data, and we'll get to that, and then I'll come right back. Jason, why don't you fire that up right now? All right, Jason, thanks for bringing that up. All right, everybody, this is going to be a very familiar format here for all of those of you who've been watching my YouTube videos on the coronavirus series. Same template, same format, everything. But today I'm going to be going through some very non-COVID sort of data. I'm looking at economic data and then also responses. What can you do about this? I'm titling this one The Dark Before the Dawn because it's my view that things are going to get a little bit worse before they get better, that we've really just started down this path of probably what will feel like and morph into something that will actually dwarf the Great Depression for a variety of reasons, not least of which is, hey, we've made some mistakes along the way. By we, I mean culturally, socially, politically, monetarily, fiscally, those sorts of things, where the primary mistake was believing that we could always just continue to borrow money ad infinitum. Hey, Hosanna, forever and ever. Never shall we have to actually pay any of that back. Well, we will. And so I'm going to talk about where we are and what's coming next and what you can do about it. But I'm going to start really with the Federal Reserve's massive mistakes. And I'm not saying this is the beginning of the end. It's not. But it may be a new dark ages. Could be the beginning of that. There's always going to be an economy. Things will pick up. We will learn how to live with COVID. None of that's really a concern to me at this point in time. What is a concern to me is the mistakes that we've made at the collective level around finances and money and fiscal policy, things like that, because your money is your social contract. That's the glue that holds a complex society together. When that glue gives way, it's like a piece of particle board that you left out in the rain. Once the glue is gone, there's no integrity left in that board and the whole thing kind of falls apart. And we've seen that over and over again. I wrote about this in part 1 to this report. You're getting this because you're an insider. You're here behind the paywall, and we're going to have a very open, frank discussion. Feel free to ask me any questions you want about any of this data or anything that I'm up to, and I will be as honest and as blunt as I can possibly be, because what I want more than anything is I want you to be prepared. I want you to come through this next period of time by thriving, not surviving. I want you to be happy, whole, well-adjusted, deep social connections, all of that. That would be my greatest hope. So how do we get there? First, it begins with understanding. So let's take us through why I think we've got just a colossal Great Depression in front of us. Exhibit A always begins with oil. This is global supply and demand of oil. Look at oil demand here. Look at this. I'm highlighting it here. Oil demand down pretty much 23, 24%. Supply has not nearly come down as fast, and of course that's why we have too much supply and too little demand, and that gives us a crashing price for oil. Hey, I know it's rebounded a bit lately, but everything's rebounded as the Fed is throwing more and more and more money into the overall situation, so everything had to kind of go up. But this right here, you could do worse than to suggest that this is about a minus 20+% decline right here. And so let's imagine that 20, oh man, that's terrible drawing. That's a 20, that's a 2, 20%. So with that more than 20% decline right here, it means that a good starting place would be to think that economic activity is off by some similar amount, at least double digits, but maybe maybe the same. Why? Because oil is the number one resource used for global trade. And so when we turn to global trade in Exhibit B, what do we see here? These are just, we've never seen anything like this before, this level of collapse. This is in a change, last 3 months compared to the preceding 3 months. This is world merchandise trade volume. Okay, so that's what we're looking at here, the world trade volume. And this is 0 here, and -1, -2, -3, -5, -6, -7. More than -7% here decline 3 months over 3 months in world merchandise trade. That is an absolutely stunning decline. It's an enormous, enormous number. We can't possibly know all the things that are impacted by that. What's missing in that 7%? Was it critical subcomponents for chips used in computers, or was it just soybeans that are missing? We don't really, it's hard to say. But this is just a gigantic, gigantic plummet in world trade. And as well, industrial production right alongside that. Here, when we see the emerging economies in this light blue, we see advanced economies in the darker blue, okay, which is all the way down here. And we see the world on average right here. Again, this is industrial production down a whopping 6% roughly here on that basis for the overall world. But advanced economies down somewhere between 8.5% or so. Just a stunning, stunning decline on just a 3-month over 3-month basis. So we see declining oil consumption. We see declining world trade. We see declining world production. And then more narrowly in the United States, Exhibit C would be these initial claims over a 14-week period, a cumulative 47 million initial claims for unemployment, so-called jobless claims. And yeah, people are like, oh, this is improving. Sure. But when a normal number, pre-COVID was in the 200,000s, as we can see down over here on this side of the chart, what do you make of 1.48 million? How do you call that an improvement? The derivative is changing. Certainly it's slowing down in terms of the overall amount, but this is still an absolutely horrifying number. So we have oil down, demand down a lot. We got world trade and industrial production down. We got joblessness way, way, way up. And again, narrowly in the United States, U.S. durable good orders, never seen any readings like this outside of like a really, really major situation like the great financial crisis here. So absolutely a massive decline in durable good orders and all of that. So naturally, what would you expect? Well, this is a collapsing economy. This is beyond a recession at this point in time. It's a massive shock. And of course, what do we see? Well, we see the NASDAQ having powered to all-time new highs. It was already at really extended, massively overpriced levels here in February, courtesy of, this is the Fed printing press, right here. Remember, I was back here in September, back here. The Federal Reserve got a little bit worried about part of its ridiculous rinky-dink financial market was blowing up. They said, oh, no, we're not doing QE. We're just throwing tons of money into the financial system because some hedge funds and some private equity firms got into some trouble with some really dumb leveraged bets they had. And the Fed exists to make sure big investors, never lose any money. So the Fed was busy dumping money in, and they dumped until they got the NASDAQ up to this all-time new high here, and then COVID hits here. And so naturally, it only makes sense that now that everything's really bad, that we would be not only past this level of insanity, which was driven by printing. This is insanity printing right here, okay? Insanity. We're past that. We're beyond insanity at this point in time. And so the way you get that, of course, is you have the most stimulus ever. This is total assets of the major central banks, and this is looking at the yearly change. So if you get to a number like 2, like we did back here in 2008, it means that collectively the world's major central banks have increased their balance sheets at a pace that would have led to a $2 trillion increase if they'd kept it at that pace for the whole year at that point in time right there. And so we see that, they tried to back off here and they got down to a 0 rate of increase. And you have to go below 0 to actually begin unwinding a balance sheet and going in reverse. So they get to 0 and oops, there was another hiccup in the stock market. So the world central banks printed again. They tried to back off again. The stock markets again started to fall here in 2013, so they printed again. They tried to back off again. We had another hiccup here. and things started to really fall apart. So there was a huge amount of printing. This was, by the way, this was the largest amount of printing here from 2016 and 17 in the entire economic disaster mess. So what was so bad in 2016 and 17? Nothing. You remember, that was back when the central banks were saying, oh, yeah, we have a robust economy and the pace of recovery is, we have a strong economy, robust, all that stuff, right? It was a lie. It was a lie because we can tell what their actions were given away by this massive amount of printing that they were doing back here in 2016, 17. But oh my gosh, here's the tiny part where they tried to go negative, and they started to unwind things a little bit in 2019. But of course, in September, their precious financial markets that were really dominated by big companies like Citadel and other giant hedge funds, they started to experience losses. The stock market started to fall apart. So boom, they started printing again like crazy. And then COVID comes along here early in 2020. And now look where we're at. Look at this. Look at this pace of change. So this is by far the most monetary stimulus ever. Okay. So that's part one in this story. And this, of course, drives the wealth gap enormously, because here in red, we're looking at the S&P 500 index. And here in blue, we're looking at the total assets of the Fed, the ECB, and the Bank of Japan in dollars. And you can see here as the stock market started to fall here, and then they started printing, the stock market came right back up with them. So that, let me undo those so you can look at them. There's really no difference at all in those lines right there. So this part right here, the Fed is printing like crazy and driving the stock market up like crazy, but so is the ECB, so is the BOJ. And that, of course, drives the wealth gap enormously. So this is an extraordinary amount of printing that's going on right here, right now. And in green here, they're showing us QE4, which began actually in September of 2019. Right here is where they started to get worried. This little tiny bit right here, look, the stock market stopped going up. It scared the bejesus out of them. You see this big power right here, this whole part? That's because they started QE4 back here in September 2019. That's all pre-COVID. That has nothing to do with COVID. So when I make the argument that we have national managers, not leaders, a leader would understand that money printing is not free, that it comes with really dramatic risks, that if you overdo it, you could actually shred your overall society and culture. And really, you would undertake it under only the most dire of possible circumstances, like, I don't know, you've got to fund a war effort and, you're losing that war and there's Hungarians at the gate, So barbarians. Did I say Hungarians? I think I did. Well, that'd be scary too. I've known a couple Hungarians. They're very tall, very solidly built. I meant barbarians at the gate. So at any rate, what was the crisis? What was so bad that the Federal Reserve felt they had to print in September of 2019 and drive this last spike higher? Well, honestly, a major hedge fund called Citadel got caught wrong on something called a basis trade where they were gambling, and that's all it is, gambling on the difference between treasury bonds and what they cost in the actual cash market and what you could buy their futures on those for. And they were scraping what's called a basis trade, or scraping a couple basis points, a few hundredths of a percentage point off of those trades. And they were minting money. They were minting money for a long time, but then it started to blow up on them. Oh no, the Federal Reserve rode to the rescue and of those very, very wealthy people and did this right here, drove that up right there. So at any rate, that's the Federal Reserve. That's what they do. They drive the wealth gap. But even as that's all happening, even as the Federal Reserve is creating all-time records in NASDAQ and driving the S&P all the way up, guess what else is happening? We're having huge credit downgrades. These are credit rating downgrades by S&P. And you can see this is a massive, massive increase in credit downgrades. So you would think normally when the companies' bonds are having credit downgrades, the equities of those companies wouldn't be going up, but you'd be wrong. That's not how it works in this modern new world. And because the Federal Reserve is so busy, backstopping everything and buying bonds and, creating this ridiculous place of world where, allegedly all the risk has been taken out of everything. Well, guess what? Guess what else? You're going to have, you show me the incentive, I will show you the outcome. So here's one. What could go wrong? It was just announced that the top U.S. pension fund, that's the California Public Employees Retirement System, the CalPERS, it's going to juice its returns by taking on an $80 billion leverage plan. Let's take a peek at that. It says here, CalPERS is to move deeper into private equity and private debt by adopting a bold, how about stupid, risky, ill-advised, bold leverage strategy that the $395 billion California public sector pension fund believes will help it achieve its ambitious 7% rate of return. Ambitious? How about impossible? How about reckless? How about never going to happen? So yeah, I love bold, ambitious. These things are good, right? We want to be bold and ambitious. We admire those traits, right? You just change a couple of the words around here and you get a different flavor out of this. I think this is a reckless leverage strategy. This can help it achieve its nonsensically high 7% rate of return. Not going to happen. In a presentation to the CalPERS board, Ben Meng, chief investment officer, said the giant fund would take on additional leverage via borrowings in financial instruments such as equity futures. By the way, those can blow up on you quick. I used to trade futures. Leverage could be as high as 20% of the value of the fund, or nearly $80 billion based on current assets. The aim is to juice up returns to help the scheme. That's the right word there, scheme. Like Ponzi scheme. That's the correct word. The largest public pension U.S. achieve its target, its growth target. Under CalPERS' previous asset allocation strategy, it was estimated to have a less than 40% probability of achieving its 7% return target over the next decade. So what are they doing here? Well, they're going to borrow at cost, we'll say borrow at cost X, and they're hoping to get returns of Y, and we're hoping that Y is greater than X, right? And that's why I made the Y a little bigger there. It's not just that I'm a bad drawer with this particular mouse. So that's what they're doing. They're going to borrow money and invest it and hope that their returns, Y, are greater than their borrowing costs, X. That's the scheme. It might work. It might not. And if it doesn't, of course, CalPERS loses a lot of money, and so do the people who are relying on CalPERS for their pensions and things like that. So, but this is desperate. By the time you have major so-called stodgy pension funds out there thinking that they have to go into super risky schemes in order to get like just basic returns so they can achieve just basic sort of 7% rates of return, that tells you that whatever the Federal Reserve is up to is driving behaviors in a very, very unsafe sort of a manner. The Federal Reserve really ought not to have done this at all, but here we are. And by the way, why not? Because we're in this sort of a world right now. We had junk bond debt. So junk debt is very poorly rated debt. It comes from companies who have very poor prospects of being able to pay it back. You're supposed to get a very, very high rate of return off of these things. Junk debt is very typically, it's a smaller component of the overall corporate debt market. Typically, you can see here, look at the June high yield. It's what HY is, high yield. High yield, it sounds good, right? High yield. Both are good words. I like high. I like yield. Sounds good. You put them together. Gives you junk debt, though. High yield, because, of course, the higher the yield, the junkier the debt. Look at this. In 2005, $5.98 billion was issued. 2018, $5.91. You see all these numbers here, but look at 2020 so far, right? By my watch, it's June. We're about halfway through. So already the largest amount ever, approximating at least the past 3 years, and then a little bit already. $37 billion of high-yield junk debt issuance. And that's because the Fed has created so much money. They've poured so much money into the system that I can't fault the companies. If you can float lots and lots of high-yield debt and people will pay you billions for it, go for it. So check this out. This is how extreme it is. The junk bonds now, they have an inverse price relationship to yield. So the higher the yield, the lower the price. The lower the yield, the higher the price. Well, this is a high interest rate here, the high yield, and so the yield has been falling. So as the yield falls, the price is going up, and we're at the point now here at 3.35 where junk debt now has a higher price and or a lower yield, same thing, than it had before COVID came along. Really? So junky crappy companies now can float debt at a lower yield, at a much higher price than before COVID? What world does that make sense in? You want to know one that really doesn't make sense? Here we saw, this is just the energy junk bond sector. You see the energy junk bonds, woo, they were just screaming because, of course, here in March, oil was falling and falling and falling. The price of oil went all the way down. Well, it went to minus 40 at one point, but that was just stupid. But it went into the 20s, okay? For sure. That was low. Again, terrible drawing, terrible. So into the 20s, and the junk debt just went screaming up. It went up, it hit a high of 24%, and then everything just reversed. And now apparently the junk debt of energy companies is worth a lot more than it was just a couple of months ago, even though the price of oil is nowhere near a level that would allow them to operate successfully, financially, profitably, and or pay back any of that junk debt. So again, this is just dumb stuff. So of course, CalPERS is thinking, we got to get in on some of that action. Man, we really missed out by not being able to take advantage of buying junk debt with everybody else. Maybe we should be able to buy this junk debt. So I have a potential future headline for you. It's going to read like this. So CalPERS is floating all those bonds to be able to do its magic X is less than Y formula right here, right? I hope those geniuses worked that one out, right? At any rate, here's the potential future headline. Federal Reserve buys CalPERS bonds, which would also be known as a bailout of a bailout of a bailout. So, they're going to have to bail out the CalPERS bonds, which were themselves being used to fund the bailout of maybe an energy debt company, which itself was getting bailed out by this flood of money that was coming in from the Fed to try and fix everything. So this is just getting crazier and crazier. Let's look at it this way. The M1 money supply versus the stock market. We have the stock market down here, down below, and we've got the money supply, M1. M1 is a very narrow money supply. So this would actually consist of physical currency, coins, physical bills, and as well it would consist of I believe the stuff that's in all the demand accounts. So that's just like the demand accounts where you can go demand your money. That's a checking account, savings account, stuff like that, right? Well, look at this. This comes from Sven Henrik at Northman Trader. You can see here, while the Fed is busy driving up the amount of money in the system at just mad rates, the stock market's going up and up and up. And then the stock market, oh no, it went down for a little bit. Oh no, not supposed to do that. And this, look at this. Look at this these green things right here. 1, 2, 3, 4, right? These 4 green things. That is mad monetary policy, and it's driving the so-called stock market here with double quotes, because it's not really a market anymore. It's so deformed. We can't even call it a market with one set of quotes. We got to go further. 2 sets of quotes. How crazy is it out there right now? Here's how super crazy it is. This is U.S. stock market valuations versus unemployment rate. The unemployment rate here at 14.7, and then I think it was 13.6 or something like that. Look at this. Look at the stock market, the price to peak earnings. These 2 little dots out here, let me take those red ones away. That's where we are. This is all of history. And going back a long way from 1929 to 2020, we've never had a situation where we've had these mass price to peak earnings here, way high here in the mid-20s compared to this unemployment rate. This is all the rest of history is contained down here in all of these dots. And here we are. So that's crazy, certainly crazy time. Another way to look at it is looking at the largest price to earnings disconnect in all of history. This comes from the Felder report. Jesse Felder wrote this very nice report looking at corporate equity values in blue and corporate profits in red. Normally, they have a pretty tight relationship to each other, as they should, right? Because, of course, the value of a stock ultimately is related to the profits of a company, not the price of the stock. So here we see that corporate profits are just plummeting right here. And by the way, I don't think the pain is at least not even remotely close to finished on that. I think corporate profits are going to be coming down pretty hard across a bunch of sectors soon, even harder than it already has right there. And you can see here the divergence with stock market going up as profits go down. It's just a crazy situation. It really doesn't make a lot of sense. And but we can look at this. Yeah, let me just get rid of one thing here because I left something on here I shouldn't have. But I think the stock market right now is looking kind of weak. Again, from Sven Henrik, Northman Trader, you can see here that the RSI, the declining momentum here, even as the stock market has been going up. And here we have a very steep decline in momentum as stocks are trying to, at least for the S&P 500, this is Dow Jones, this one, trying to get back up to its all-time highs. NASDAQ has, the Dow hasn't, and neither has the S&P. But at any rate, it took $5 trillion in central bank intervention in 2 months just to create that little bump right there. This one took $5 trillion in central bank intervention over the course of 3 years, and so on and so forth. So at any rate, there's a good chance because of this, get the right one here, because of this decline and this decline here, even though this is going up, I think there's stocks are looking a little bit weak here coming into this. So if you have money in the stock market and it's not on the short side, you'd want to be cautious there, very, very cautious. And as well on the fiscal side of the story, we have the largest fiscal deficit expressed as a percent of GDP since World War II. And there was a really good reason back then, I think, to get into a fiscal deficit. But we also had a very different set of circumstances back then. Remember, when we're back here in the 1940s and the government's running these huge deficits, sure, things aren't completely certain back then. But what we did have was we had a lot of oil, and we had a lot of natural resources. We had a lot of net energy. We had a lot of things going for us that said, hey, you know what? We could dig out from under this enormous deficit right here. Plus, there was a little thing called the end of World War II that happened that enabled us to get out of that particular deficit hole. And what happened there was the United States was left with a more or less intact manufacturing center. Japan's was ruined. Europe's was ruined. Those are two huge markets. We had a Marshall Plan that allowed a lot of the U.S. products to go over and satisfy Europe and a variety of things. So we had cheap oil, high net energy oil, and an intact manufacturing base, and a couple of key markets with ruined manufacturing bases. So that all actually led to pretty favorable conditions to allowing that deficit to be undone there. What are we talking about this time with a minus 24.6% deficit to GDP? We don't have any of those factors going for us at this point in time. None. We've got none of them. We don't even have a manufacturing base like we used to have in World War II. So at any rate, this massive amount of fiscal deficit, again, maybe deficits don't matter, or maybe they do. So I think that between the monetary madness we have going on and the fiscal madness, these two things together say, I don't see any way out of this, people. I really don't. Not without it being very, very painful, because if the government tries to cut its deficit spending, that's an enormous hit to GDP right away. And if the Federal Reserve tries to cut its stimulus efforts, of course, their precious stock market will fall right away. So both of these things, the GDP as it's expressed in the stock market, are both being boosted by large amounts of thin air printing and thin air spending is how we'd have to look at it. By the way, when I say markets, and I put double quotes in there, we have to understand these are rigged markets. This, again, I've been putting up a chart like this for years, and it's fun to see it now come out of the New York Times. Whoops, wrong pen again. Let me get the yellow pen here. The New York Times finally caught on to this and discovered something that I've been pointing out for years, which is the cumulative return since inception of the SPY ETF, which tracks the S&P 500 stock index through January of 2018. During the regular hours, the stock market has actually lost money. If all you did was hold stocks during the open cash hours, which they report on every day, like, oh, the S&P went up or down X or Y or whatever, you would have lost money. Whereas if you'd held it outside of regular hours, you would have made these massive returns right here, truly massive. So how is it possible that the S&P, on average, only goes up at night? What happens at night? What's so bullish about nighttime? You know what's bullish? It's a thin, little, tiny market where the mice can come out and play, and they can jam prices around and wing them around. And it's not just traders in my world. I'll bet you anything, I'd put a lot of money on this, that includes what we'll call official players. That will be central banks. That would be proxies for the central banks. That would be the truly massive companies that never get actually investigated by the SEC for doing their price manipulations, things like that. And of course, why doesn't the SEC investigate somebody who's manipulating prices? Well, because they're manipulating them in the right direction. If this chart was inverted and you found out that outside of regular hours, the stock market was being driven down relentlessly I'll bet you anything there would have been hundreds of SEC investigations into that, and there would be people in jail. But because it's going up, nobody looks too closely. And by the way, it's not just big things like the S&P 500, small caps too. Same thing. IWM ETF in the overnight. The day session has returned minus 53% since 2000. The overnight sessions returned a plus 702%. And by the way, there's no such thing as a market where you can reliably win all the time because it's not a market anymore. But everybody on Wall Street already knows that this is the case, that when you're trading at night, you're trading with a strong upward bias to the overall results. So at any rate, that's just how that goes. So that's why I say it's totally rigged market. And when things are rigged, they're unfair. George Floyd was the spark, but there's a lot of things under that iceberg, beneath the waves, as it were, that really speak to things about the lack of accountability. Where's the accountability? Why isn't anybody in jail for this? Why is the SEC not investigating this? Because they don't care for some particular reason, right? Which is, well, these things are going in the right direction, so we're not going to follow along with that. So no accountability for whoever it is that's rigging those overnight markets for sure. We got this massive unfair wealth distribution that's been happening courtesy of the Federal Reserve. That's what they do. We got the Federal Reserve picking winners and losers, of course. We got all these corporate rackets. We got militarized police. We got this horrible civil asset forfeiture laws. We got stagnant wages. The government's lying about inflation. You got the student debt fiasco, where even universities thought it appropriate to burden the people they were most charged with raising to become the most productive elements of our society, the students, and saddling them with crushing debts that were going to utterly shape the rest of their early adult lives. And so, yeah, even universities are all like, yeah, we want in on this racket. What can we squeeze out of students, right? You got these zero interest rates, so that's stealing from the savers. You got the mega bailouts of Wall Street, on and on and on and on and on and on, right? So that all leads us to this, which is the Fed and the current political managers. They only know how to make things more unfair. None of these things have really been reversed. Most of these, I haven't seen any of them reversed. There's one possible thing where recently the Trump administration pushed, and now hospitals, kicking and screaming against this, hated it. Hospitals are going to have to post their prices so that you could actually, as a consumer, know what something was going to cost before you bought it. What a great thing. Of course, hospitals hated that. So that was actually my one bright mark in the last quarter or so. But otherwise, everything seems to be going this way, and that leads to people being unhappy. We shake our tiny little monkey fists at the unfairness of it all. We don't like it. And even though a lot of this is characterized in terms of Black Lives Matter and justice for George Floyd, that may well have been the spark. But this stuff was all lurking beneath the waves and is adding fuel to that. So these are just a lot of unhappy people. They're feeling the unfairness of the system. And my prediction is that we're going to see more of that because the managers can't think of what to do except more of the same. So when the Federal Reserve says, this is what we need to do, this huge giant sunflower on a stalk over here, that's the right response. Even after they know that didn't work right there, this one, that didn't work, and this didn't work, and this didn't work, and this didn't work, except for it did make the wealth gap get monstrously bigger. And of course, on that basis, they said, well, then why not do more of that? But what it didn't do was deliver social justice, equity, and opportunity for all, especially different races. When the Fed jams this up and creates a wealth gap, let's be clear about this. They're mostly creating a wealth gap between white households and everybody else. Because, on a numbers basis, most of the wealth is concentrated into white households. And even though Asian households may be, on average, slightly more wealthy, there's fewer of them. So on balance, what's the Fed doing when it jams its precious financial stocks higher? Well, it makes the already wealthy even wealthier. And who's that? Well, mostly white households. So that's what they've been up to. So no question that this is happening. For me, editorially, I really don't think it ought to be this side against this side. I think both these people are actually on the same side. They have the wrong enemies identified in this particular picture right here. And so the real enemies are those who would ruin our money system and those who would bestow unfair, just rewards on one class of people over everybody else. All right. Hearing all of that and sharing that baseline, the question comes up, so what do I do? What do I do about this? Number one, I want you to make sure your money is very safe. We do recommend these endorsed financial advisors over at New Harbor. If you go here to greylockpeak.com, you can get a free financial review with these guys. Mike and John and Justin, awesome guys. So at any rate, great investment advisors. So you could talk to them if you felt you needed to, or just make sure if you're doing it yourself or whoever you're working with, make sure that your money is actually safe and not totally exposed to a rigged system because you know how rigged systems are. It's all fun and games until they decide to pull the plug on them. And then a lot of people lose money because it's rigged. That's what happens when you play at a rigged card table. Everything's going great until you make the really big bet. And then next thing you know, the other guy gets 4 aces somehow. How did that happen? Nobody knows. All right, make sure you have lots of hard assets. Things like, of course, obviously gold and silver. And land. I like land. I like productive farmland. I like trees. I like all sorts of different hard assets out there. So, but these would be the two biggies right here. Very easy and portable, gold and silver. And of course, this stuff is never going to go out of style. People are always going to need good land. And that back to the land movement, really strong out here in Western Mass right now, I think, with all the people from Boston and New York especially, fleeing the city, coming up and looking for properties to buy. So if you're going to get in on that trend, get in early and often. Hey, a quick aside, another reason I think that gold is a pretty good investment right here, right now, is because of this extraordinary shape. This is the big run-up that brought us up to about $1,900 an ounce. And then this, in chart speak, is what's known as a cup. And I expect us to draw a little handle here at some point. And then it's going to be off to the races if it does that. So this is a very bullish shape right here. I like that. And part of the reason I like this shape at this point is gold is actually the anti-dollar. So if the dollar goes down, gold tends to go up, all other things being equal. I mean, gold has been going up in dollars. Even though the dollar's been fairly strong, gold has been stronger than that. That's true. But if the dollar goes down, gold becomes even stronger again. So another reason I think gold could do well is because of this. This is looking at the DXY index in black, which is the dollar index. And so when the dollar index is going down that way, that would be down, then it's weakening and gold would be going up. And there's usually, not always, but usually a reasonable correlation. You can see we had a bad correlation during this period and not great one here. But on average, you see a correlation here between excess reserves in red. So a year-over-year percent, when you look at the excess reserves right here, and the question is what happens now that excess reserves have gone in this direction. And so this chart would suggest we're going to be seeing the dollar follow along, and I don't know why that never picks it on the first click. Let me do that again. We'll see the dollar go like this at some point. That's a guess. It's not a guarantee. Again, the correlation is not super awesome, but let's make a smiley face out of that. But it's pretty good. So just another thing to look at. Number 3 on my list is improve your soil. And this is just beautiful looking black soil here with a lot of organic matter. Get a compost bin. This isn't mine, but mine looks sort of like that. I just picked a picture of this one because it's got a flower on top. It looks good. I want you to grow your own as much as possible. Hey, this is a picture of me walking back to my kitchen the other night, getting ready to eat some dinner. So grow your own, get a garden. Absolutely the right thing to do at this point in time for all sorts of reasons. Number 5, I want you to consider investing in your home. Things like insulation, solar thermal panels here. I love those. So photovoltaics, solar photovoltaics can also make a lot of sense. Things like that. So anything you can do in your home and your homestead that's going to be a material capital improvement, particularly things that will allow you to spend less money because you've made this investment. Now, that would be a good thing. And of course, solar hot water just makes just a ton of economic sense for the most part. And as well, you want to build your social capital, know thy neighbors. This is going to be very important going forward. See what you can do to get reciprocity going, build your networks up, know a lot of different people in town, participate in things, absolutely. You want to be building up those feelings of trust and safety with each other and increase your sense of belonging. And of course, it helps if you can find people who share your values and norms. And of course, your outlook in life will be improved if your social capital is boosted. This next one, a little bit touchy for some, but I'm pretty clear on it. You want to be prepared to defend yourself. And this is also falls under the you're on your own philosophy here. So be prepared to defend yourself. A lot of people are catching that vibe. I've been obviously, well, maybe not obviously to you newcomers, but I've been very active in the shooting community for 35 years now. And I feel pretty proficient at this point in time. And I take it seriously, and I like to train, and I like to compete and all of that. But if really a lot of people are starting to catch this vibe, especially after we see things like that Capitol Hill Autonomous Zone, the Chaz out there in Seattle, when you see the breakdown in social structure and order, when you see police pulling back from areas and sort of violent mobs taking over. Those are all reasons I think that you would want to be able to defend yourself. And even in places that are traditionally very, very liberal, we're seeing the vibe come along. I've had formerly, I guess they're still very liberal, but formerly super liberal friends of mine say they're rethinking the whole gun ownership thing. And of course, they're not alone. Here we see that, let me get rid of that. Illinois gun permits applications are soaring 500%. As frightened liberals, I'm not sure if that's the case here, but maybe it is. Embrace the Second Amendment. It's kind of a grabby, maybe clickbaity title right there. But that is Illinois has got some of the most restrictive gun laws out there. Chicago, in particular, despite the fact that Chicago has some of the most restrictive gun laws in the whole nation, it also suffers from some of the worst gun violence in the whole nation, showing that maybe there's not that much of a connection between the laws and the outcomes when you get right down to it. But at any rate, 40,000 Illinois residents applied for a gun permit over a 2-week period this month, a jump of more than 500%. So it's a vibe. It's out there. I think that if you are not already on the path to defending yourself, it takes time, and you're going to want to get started on that. If gun ownership is something that you think makes sense for you, you got to get the training, you've got to get the license. Of course, then you have to acquire something. You've got to use it and practice with it. It takes time. It really does. And then double up. I happen to have this exact fence charger right here. It's on based on this is a DC one, so I can run it off of solar and a battery. But I don't have one. I have two. And the reason I have two is because I'm not so sure that all these components are going to be there when the time comes. I'm not so positive that I can just waltz into a store a year from now and buy it. Absolutely need to have a working one. So yeah, got two. And I can't imagine living without a Makita impact driver either. So I have two. So my advice here is to double up. All right, so now for a quick tour of what's been going on here at Honey Badger Farms with Evie and myself. A quick update on our 3-month progress. This little beauty right here is a peeled cedar log. These cedar logs were cut on the property, and then they were peeled, and then a bunch of them were stacked up and peeled, and I had a gravel base put down. Unfortunately, we were going to stand, not unfortunately, but part of the project is you always find stuff out, and these poles were going to stand on concrete piers. I thought I was going to be able to use my tractor to dig those holes. Nope. The holes were just a little bit too full of rocks for that action. So they kind of got dug out, and here's Evie demonstrating the depth of these holes. They go down 4 feet, and check it out. You want to see rocks? Trust me, there were some rocks in those holes. This is an old riverbed. That's why they're all smooth like that. The soil on top is great. There's a few rocks down below. At any rate, here you can see the sonotubes in, and the concrete's been poured. And now we're standing up the posts. This is a pole barn. So these poles are getting stood up right there. And then there's one of the few action photos you're going to see me in. I had to ask somebody to take it. I'm the guy with the camera, so usually you see other people in the pictures. At any rate, here we are. Here I am, in this case, putting this up and putting on some bracing. And when all is said and done, this is going to be housing our hay. And then after the cows eat it, we're going to be putting the tractor and other things are going to live under this pole barn. Overall, I would say this whole thing, maybe $3,500 with all included. That includes the labor and the materials. So I'd have to add up all the bills. It could be 3, could be 4, but I think 3.5 is a pretty decent guess. So for a 40-foot by 12-foot building, covered area, that's a pretty cheap price to be paying. So happy with how that came out. And of course, the garden, remember, this is a picture we took way back early spring, and this is the garden area we were working with. Fortunately, it was already fenced off. Fortunately, people had been gardening in here for a long time. Unfortunately, it's full of raspberries here, which I didn't want in the garden space. I wanted them outside the garden space. And this is all that Bermuda grass, all this stuff in here throughout this whole area. So this Bermuda grass is what it looks like. It has all these rhizomes, all these things here, any fragment of which will sprout happily into a whole brand new plant. And we had to get every single piece of that out. So what'd we do? Well, here you can see where we burned around the outside of the garden to sort of knock some of that grass back. But each bed was dug out, and for a while, we were just going through and pawing through the dirt, and then we figured out how to sift the dirt. We made a small sifter and then a larger one, and then finally a really big one. So I think we've got the process down. It's still a lot of work, but there is a way to do it that's pretty efficient. And here we are, still early spring, and we're moving the plastic around, hoping that we'll be able to kill this grass with the plastic. That didn't work out. All we did was sort of make it go into slight hibernation for a little while. And as we continue to work through, we're chewing through, we're making beds here and sort of governing the overall layout. But as time went on, I think you can see we started to really get a handle on it and master it. This is the garlic here. These are some beds of various brassicas, cabbages, broccolis, and cauliflowers, things like that. And we're using a lot of mulching here. Evie's putting down a lot of mulching over the strawberries, which are small in this particular picture. We also figured out how to work smarter. We have an absolutely wonderful young man, Everest, here working with us for the summer. He's in between college and a graduate program. And he's just been an absolute, it's wonderful to have just such smart, intelligent, curious, dedicated help here for the summer. So here you can see Evie. Now we're working a little bit smarter because we got some help finally, which is big help. Huge. We're running a hugelkultur experiment, which in German means wood culture. So here's a bunch of old rotted wood we had, some fresh green wood on top, leaves to kickstart things. We've got the cardboard underneath it all to help block out any of the grass that we might have missed by accident. And then we are with our large sifter, and this is with another local gentleman here who lives up the hill, coming and working, helping out. So this is part of the sifting process, and this is a bed where you can see all the sifted dirt on top of it. And over time, this is what that garden is now looking like. You can see through all through the whole thing here that we're really starting to master it. And as well, if you see here these black lines, we have it on drip irrigation right now. And of course, drip irrigation is the greatest invention for gardeners ever. Can't recommend it enough. It's a little bit of an investment to get it all set up, but not that much. It really snaps together. But once it's snapped together like this, now for me to completely water the garden involves me turning a single knob as I head out the garden before I go to bed, and I come out in the morning and the whole thing is just watered perfectly, like 1.5 feet deep. It's just astonishing. And after all that work, abundance has arrived. This is what one of our garden beds looks like right now. It's a mixture of lettuce and red cabbage. It's just coming along fantastic. So feeling really good about the effort so far and feeling like this is a great first year effort. Almost broke our back in our bank. But we won't have to do that work again. We won't have to sift the soil again. We won't have to set up any of the drip irrigation next year. We just get to plant straight into beds that are going to be have much richer soil in it than they did this year. So feeling good about all that. But boy, the first year-itis, jeez, a lot of work that first year. A lot. Here's my most precious resource. This is the one I love the most. I don't know if anybody else is quite as excited, but if you see this pipe right here, you know where that goes? That stretches up the hill almost 2,000 feet. We had to run only 500 feet of that line. The other 1,500 feet was already run for us and by the previous owners. And that pipe goes up to a spring that's flowing 15 gallons per minute and during a drought period right now. And it's 200 feet elevation higher. So we have all this water coming out. All we had to do was plumb it in. Here you can see these are the drip irrigation pieces. And this is just a gardening hose right here that goes out this way. This is all coming out under such extraordinary pressure. I don't know if you can see from this picture, but this is watering the back of this bed, which is almost a 20-foot long bed. And I can reach it with a simple garden hose. The pressure, I'm guessing, is about 130, maybe 140 PSI. It's astonishing to have that much water. And by the way, no moving parts, no pumps, no nothing. Just a tube that runs up to a spring that is just flowing water. I'm blessed. What abundance that is. Unbelievable. 100% gravity-fed abundance. We're also on an urgent composting effort right now. These are wood chips from some projects that have been going on in and around our property. And here we are repurposing a whole bunch of pallets from the feed store. And this is wide enough that we can get the bucket in from the tractor, and we're layering wood chips and then green manure, as it's called. We're cutting things like what you see behind this picture even. We're cutting things, and another layer of wood chips, then more green and all that. So we're hoping to fill this thing up in the next week or so and then make another one and just keep moving like that. We need a lot of compost for all sorts of things, but the garden is number one on the list. As well, we're under an urgent field remediation effort. The field was really used pretty hard, so this is a spreader on the back of the tractor here. And this spreader is, first we lined the field, and then we actually had to put fertilizer down because it was so depleted of nutrients. And now we're just waiting for it to rain. If it would just rain, those nutrients could actually get into the soil, and that would be great. But our attempts to reseed this field out here with nitrogen fixtures like certain legumes, hairy vetch, alfalfa, things like that, as well as clover. All those, they all sprouted fine, but they died because we got basically zero rain for all of June, except for a half inch the other day. But it was too late for the reseeding, so I'm going to have to reseed it this fall. And I'm going to do a really incredible cover crop. Hey, thank you, whoever it was that posted that link. I forgot who did this, to Gabe Brown, the cover crop specialist out of South Dakota, I believe. Oh my God, that was a fantastic thing. I'm going to be following his advice and putting on a really, really incredible cover crop this fall, which I think is going to help a ton. And on July 3rd now, we have 4 cows and 2 pigs arriving. The other side of this structure, on the other side over here, is an open door. We now have panels up all around this. We have a gate right here. This is an enclosure. This is for the pigs. And we're going to stretch hot wires all the way down this field, all the way back up and all the way around here. And then we're going to section this off in little pieces like that so that the pigs will root up and eat through little individual areas of this field back here. Because this field, let me see if I can do this. Yeah. This field back here is full of poison ivy, sensitive fern, cow parsnip, all kinds of undesirable species. It just needs to be plowed and tilled and all that. And that's what the pigs are going to do for us. And if we put them in a small enough area, they will plow and eat through all that. This right here, that's all poison ivy. This was all poison ivy through here before I mowed it down to put this up. So we got a lot of poison ivy, and I'm hoping the animals are going to help us get rid of all that. So that's the plan right now. So those are just a few of the things that we've been up to here in our first full active 3 months, because we closed at the end of January. February was, I don't know, well, kind of did a little bit of moving and started getting our feet under us, but we really didn't get started on this project until about mid-March. And so that's from March to April to May, here into June. So those 3 months, that's what we've been up to. Got a bunch of other things going on, just didn't have time to sneak them all in here. Conclusions for today. The Federal Reserve is making some really huge, giant mistakes. And so is the government, and the monetary and fiscal excesses, we believe, are going to blow up more than they already are. It's already desperately hard for a lot of people out there who are struggling, having lost their jobs, having already been in debt, having been a household that had $400 of emergency reserves, whatever the story was. People were already very largely clinging to their existence before COVID came along. Some of them are doing better temporarily as the government shovels money out to them in terms of unemployment benefits and other things like that. But when or if that money stops, and I don't think it will this calendar year, or at least until November, because, hey, it's an election year. One thing that politicians can always agree on in an election year is finding more money to hand out to potential voters. So I think that'll continue, but I think this fall is when things get a little shaky in particular. Social unrest is going to continue because of the structural unfairness, because the managers can't think of anything to do besides make it more structurally unfair. It's just how they are. It's how they're built. It's kind of how humans operate. It's unfortunate, but it means changing by pain, not insight. I think supply chain disruptions are quite possible. I think that you should very strongly consider having 2 instead of 1 of anything that you really think you will need. If we had cows and we ran out of, if our charger broke, our fence charger, and we couldn't get another one, we'd be in a world of hurt because I don't know what I'd do. I'd have to build split rail fences, Abe Lincoln style. I don't even know, right? I'm not sure how I would hold them in. So at any rate, get 2 of anything that you think is really critical. And by the way, it's time now. It's just time. That's what this whole presentation is about here. It's time to build up your soil. It's time to build up your social connections. It's time to build up your hard asset piles. Whatever those things are that you know are going to be important to your current and future resilience, I'm here to urge you to stay focused, get on those, and really do everything you can to build up your resilience as much as you can. Why? This is because you need to put your oxygen mask on first. Why? Well, you're probably going to be in the position of helping people if or when things do take a turn towards the darkness before it gets brighter again. If this Great Depression really kicks off in earnest, whether that's an inflationary depression or a deflationary depression, one way or the other, the money system will have failed us because our managers will have failed the money system. So at any rate, that's why I think it's time. I could be wrong, but I'm not confused. So I'd love to see whatever your efforts are in any and every dimension, and I'd love to have the comments down below here. Let's talk about how are you building resilience. I've shown you some of the ways that I'm going about it. I'm building up soil. I want abundance. I want animals working for me. I don't want machinery working for me. That's the decision I've made and Evie's made, and so we're going to push that as much as we can. But hey, that's what we can do. Lots of different ways to go about this. So we'd love to hear what you're up to and how you're going about it. Love to. All right. That's what I've got for you today. Thank you so much for listening. If this is a successful way to communicate with you, let me know, and we'll do it again, because it's certainly a way that feels native and natural to me. It's a way I know how to articulate things relatively clearly and cleanly, and sometimes people prefer spoken and or video material more than they do written. So, hey, just let me know. All right, let me end this and go back to talking to you directly. Well, thank you, everybody, for watching that and for listening. And I hope that you've found some inspiration in the last series of pictures and what Evie and I have been up to. I know not everybody can do what we're doing, but even if you live in a small suburban lot somewhere, you've got plenty of things you can do around building soil, getting a garden in, investing in your home, all of that. But really, honestly, my point here is it's time for you to take those 7 steps that I outlined there for becoming prepared. And as well, if any of you are going to come and visit sometime, at least now you know what this looks like here. And remember, we're looking for people who are going to come and help us work at this place, because it's just nothing but work for the next few years as far as I can tell. But I'm already really pleased with how it's going, and really pleased to be on this journey with you. And let's hope for the best, but prepare for the worst. And I think it really is time to admit that the Federal Reserve is off the rails. They're going to do what they're going to do. And listen, they're just managers, and they're operating from their playbook, and they're not good managers. So we're going to get bad management. Bad management often leads to bad outcomes. Can't be sure of that, but you might as well prepare as if that was the case. In the meantime, this is actually a much better, more resilient, happier, more well-adjusted life to be leading. And I can't wait for the day when we get to sit back a little, breathe deeply, and enjoy all the progress that we've made this year. So with that, thank you very much, and we'll be back soon.